Let's get more with Stephen Nash, who joins us from FIIG Securities. Stephen, thanks so much for your time. An interesting reaction overnight to these Basel III changes. Certainly European banking stocks like the sound of it, but not so much European markets more broadly. In fact, some analysts we spoke to this morning say it was a little frightening because it is a step back in terms of regulation. What did you make of the reaction?
Look, I think the reality is that the European banking system needs as much support as it can get at this point. Introducing new regulation right now, I think, would reduce credit growth and would be negative for growth at a time where Europe is really struggling to find traction in terms of growth at all in 2013. It's really a question of how severe the recession will be over the entire year, not whether they're going to be in recession, I think, right now. So I think the move by regulators is a positive one for the sector. Looking at some of the individual stocks, the stocks seem to have been anticipating this news for quite some time. So, expecting large moves on the day was probably not something that you should have been looking for, I would have thought.
Although we did see some gains. What about here at home? We still haven't heard from APRA. Are they going to allow these easier banking regulations through here at home?
I think broadly, APRA have been trying to showcase the relative strength of the Australian banking system by trying to introduce regulation or increase regulation more quickly than other markets. So I imagine that they probably won't allow most of these through. There may be some changes, maybe covered bonds. There might be more treatment or acceptance of covered bonds by APRA. It's probably about it. So the impact for the Australian banks is quite neutral, but nevertheless it was a positive release for the banks, and against that we saw yesterday a bit of a key reversal in shares like CBA. Now I think that's interesting because I think the market is generally beginning to see that a sign of success in terms of the overall capitalisation of the bank is now going to be reflected in increased regulatory costs. I think a bank of the size of CBA, and not to mention the other major banks, will attract over time increased regulatory costs, and I think that eventually will limit the amount that the banks can pay out in terms of these large payout ratios that they've been practicing for quite a few years now.
The other thing, of course, we're watching is funding costs for those big banks. Can you just give us the status quo, how they're sitting now?
Well, the 3-year basis swap for the major banks, which is what the banks use to swap back from overseas currencies, is improved somewhat. We've seen a general decline in funding costs for the banks over the full year of 2012. It's been quite dramatic, of the order of almost 80 or 90 basis points in terms of the 5-year. So broadly it's been a positive story for the banks, but the problem for the banks going forward will be this basis swap, and we've seen Westpac announced that deal this morning, taking advantage of the contraction in the basis swap, and I think the other major banks will probably try to take advantage of that as well. When the banks issue offshore, of course, it takes the pressure off local spreads, and we can probably see even more contraction given what's been going on in equity markets of late.
Okay, let's talk about the RBA and expectations for February. We've had the AIG HIA Performance of Construction Index out just in the past few minutes, a slight improvement, but it's still in contractionary territory. We've also had Dun & Bradstreet out with a retail read today that shows prices are still coming down. How do you think all of this is likely to sit with the Reserve Bank? Because on the other hand, we have iron ore at 153.
Look, I think that this transition from mining-led growth to construction is not going to be an easy one. The market at the moment seems to think that it's going to be smooth and everything will be fine. I think the RBA are quite cautious on this transition. I think one of the problems here is the bank's approach to lending to the construction industry, the property developers in particular. They've become very cautious, and effectively the lending to this sector has been cut dramatically. So expecting large increases in construction, even with lower rates, is probably a little bit optimistic. Hopefully we can get some sort of loosening of the credit to the sector, and that will allow more construction at the end of the year. But I think early on it's going to be quite difficult to see much improvement in the construction sector.
Stephen, we saw quite a lot of movement in the euro overnight. We have an ECB decision out later this week. What are you expecting from the central bank? It sounds like there's not supposed to be any change, but there is a lot of currency movement ahead of it.
Look, I think with regard to the ECB's cash rate, it's going to be difficult for the ECB to cut, because as they cut, that would tend to bring cash rates across European banks much closer to zero. And at this point, flight out of deposits based on very low cash rates is probably not something that the ECB would really like. Obviously, an easing is probably justified at this point, but I imagine that they will leave the easing for a while, and there will be, I think, opportunities within 2013 to ease based on weak economic conditions. So it's probably something for the next few months to look forward to.
Okay, great. Stephen Nash from FIIG, thanks for your time.
Thanks very much.